Hello, traders. New week, new opportunities. Who's ready? You guys ready? I know by Sunday night I'm ready. How are you, Pete? Ren, Brock, Shepard, Laura, nice to meet you. Who else is here? Surinder, Bamshi, Mark, Michael. Thank you guys for being here on time. There's an expression in the Midwest, and if I'm not early, I don't feel on time. So let's take a look. Peruse. Good for you, Pete. Hi, Kevin. All right. So something that doesn't show up in our charts because most of the things we follow are 24/7. But a few people are talking about it. It's a rare formation. I've showed it a few times here. Could only show it a few times here because it really doesn't happen in 24/6 trading, except Monday night gaps really don't come into play. But here's a spider right here. And the spider does close, okay, even though there's some aftermarket action. Look at this island top that formed here. So we're not getting today's action in here because it's closed, okay, but pretty rare. So what happens? You have Gilligan and the skipper, the professor, Marianne, and Ginger are here on the island, and they can't get off. Now, will a rescue ship eventually try and come to the island and fill this gulf? Maybe eat into it, but we're sharply lower today. So taking into account today's action, the low is pretty important, I'd say. Look at this and this is a daily chart, and this is a daily chart with 24/7. Look at what we're holding right here. Yeah, so I mean, we're right at the 50-day moving average. So this has already been about a 300 point decline from the highs of 33.30 to call it around 29.30, just in round numbers. So if we take out this moving average just arithmetically, you just subtract 300 from here and it gives you 26.30. Oh, what a surprise. I know, this is what I've been thinking we could go to through here is this 26.30 level. That's where we this was a 38%. Yeah, Gilligan. What a Meshuggah he was. All right, Jess will sell the next pop here. So we'll see what kind of pop we're going to get. This was important because this was a throwover line that it didn't even quite get to. Let me show it to you. Yeah, on the bounce that we had the other day. So this is it. The throwover line came in at 30.95 or so, and we got to 30.90. You can't hear anything? Okay, everyone else has good volume, right? So I also want to share, I've been watching traders for many years, besides my watching myself and other traders. I'd have to say that this was the best birthday boy. Uh, uh, the best birthday boy
You won't find it there. It's closed now.
day trade that I've seen in my entire career. And that was Steve. He got short on that pop to 90 right in there and closed it out for a nice 2.58% gain on that scalp from Friday. Congratulations, birthday boy. May you have birthdays 365 days a year. And you know what?
Thank you.
This wasn't too shabby. It
No,
wasn't
no, it
Greg's
was
birthday.
great.
See, Grega doesn't need a birthday to perform like that. Look, he almost did twice as well as Steve on that. So these are the pattern and plays that you're going to get as a member. and you don't have to be in front of your desktop. If you're out and about, it'll push it to your phone so you know, and you could go ahead and execute the trade. And Martin doesn't see my Mariette doesn't see my screen, and I keep making this too loud. So, all right. So, great.
Your screen is fine.
Okay. So,
So
just a
they need
couple of
to, to check
yeah.
what they're doing.
Yeah. Why don't you log out, come back in if you can hear me, but you can't see me. So, um, I want to talk about the dollar, and with all this risk off, I know we had a pop, but I'm just not impressed with the follow through.
Yeah, nobody
I mean,
is.
yeah, so we'll see. I mean, to me, it's not a big risk off play yet. So we'll see. Uh, in fact, I have a if you're a dollar, and we all trade the dollar one way or another. But Keith from Ice Cap Global is going to be here, and he just wrote a piece that's floating around Twitter about the potential of a revaluing of the dollar. And let me just say that it has something to do with it's not as much financial as it is political and can be used as a pressure point against China, which I don't really understand. I always thought they wanted a weaker yuan to make it easier to export, but uh, the last interview I had with Keith was eye opening. He's great. You want to hear the story about what could happen to the dollar. He was giving it a 0% chance of this happening a while ago, but says the odds have increased for that. So it's going to be an excellent interview to edify you.
Zero percent chance of what happening exactly, Dale?
Revaluing of the dollar.
In which direction?
Revalue. So oh yeah, up.
Okay.
Revaluing, not devaluing. So yeah. So he's going to talk about that, and this is something that I think is going to be important, even though the metals are down today. I'm not short. I'm not long. I thought I'd have another chance to short silver up here at new highs, and I'm almost tempted maybe today or tomorrow to try the gold because I do think we'll crack 1740 and make new highs for the move. I could be wrong, but I'm looking for a third drive in gold. Here's one, here's two, and it's got to dig its heels in soon. Back under the 680, the top's in. So very important week here in gold as well. And I wanted to just point this out because I think it's going to influence trading for quite a bit. I'm not saying that we can't have another push down to the support level, but to me, this is saying that when I'm bearish precious metals, silver is my preferred short. And when I'm constructive precious metals, gold is my preferred long. I think it could rally back to at least this. And if we get through here and no one thinks it could happen with everyone being so enamored on the silver, but is this really the historical high? I mean, this says no. Okay, that this move was confirmed all the way up. Could have just been, exhaustion up there and it's over. But, it almost looks corrective to me. So I'd be looking to sell silver on strength on good rallies and buy gold on dips until we at least maybe correct half of this, which would take it back. We've had about a 33,000 point decline. So 15 is going to take you up to about 108 or so, 109, which will crack this. So I know that a lot of people are going to, say, well, silver is still the buy. It's got a lot of catch up to do. But if this is turning up, silver is not your preferred long anymore. It was all the way since March, since this high, but it may not be anymore for a while. Okay. So that's about all I wanted to cover today. We always invite you to become part of our community so that you're getting these kind of trades sent to you. And I'm not saying that we're always, uh, uh, you know, right, you know, but we have a pretty good hit rate and 52.5. And when average targets 3 to 1, you make money doing that. So I invite you to join and become part of our community and hang out in the chat room with us and get all this great research for a very reasonable price. And with that being said, I'm going to bring Blake in. Hope you had a good weekend, buddy. Weather was beautiful here in San Diego, 80 degrees, 75, nice breeze.
Oh, that's
Maybe it
nice.
wasn't steaming. Maybe it wasn't as steaming there this weekend, was it?
Oh, it's hot. I mean,
Yeah,
it's summertime here, so it's
yeah.
gross.
All right.
Yeah, so I mean, I think about Monday mornings for me, and unless something really dramatic happens over the weekend, usually, like the update that I give for the week ahead video is pretty valid. You know what I mean? There's not a lot for me to say. There is, although I do feel that this morning we might have had something happen that I think is fairly important for FX. And you look at the Aussie dollar, and
Mm,
what's happening with the Aussie is we're actually below the
mm,
uptrend line
yeah.
that we've been following, since the very bottom. I mean, we're actually below it now. So I think the risk of the Aussie actually breaking down is pretty good at this point. The only issue that I'm having with it at this very moment is that we also kind of falsely broken below the 68 cent level. So you can see that 68 cent was like we pushed below there in European trade. So I think a lot of people that might have shorted the Aussie dollar in early European trade, or probably closing out the shorts because they're like, oh crap, we're going to get squeezed. But I still think while the Aussie trades below like 68.50, the risk of a move lower is still pretty high. So for those of you that are trading the Aussie dollar, and I think that's like a pretty key development that's happened overnight. We were looking at currencies just in general, as for the week ahead video, and it's not like there's any huge developments other than I still feel the euro dollar is going to slide towards 111.50. We're actually holding the 38% retracement. Let me delete this little zone here. We are, you can see the 38% retracement at the 112.10 level. That was tagged and held late last week. And so that's going to be pretty important. And, like I said, I still think that the risk of a move down to 111.50 for the euro dollar is still quite high at this point. And if you look at this is a 4-hour chart, you look at the setup here, this is more like a flag, right? Am I bearish overall the euro? No, I actually, I think that we can slip down to 111.50, but that might be a better area to be on the long side of the euro. As I had mentioned during the week ahead video, we have the EU Council meeting at the end of the week, and I still think there's the continued risk of a more unified European Union is really the risk for the euro, which means that it's upside risk. So I think a pullback towards 111.50 a little later this week, whether it's Tuesday, Wednesday, today, might offer a good opportunity to be on the long side going into the end of the week. So just keep that in mind. I mean, you're looking at the 4-hour chart of the euro dollar here, and if that's a bear flag pattern, or a pennant, that target of this euro dollar would take us right down to 111.50, right? So I think that could very easily play out. That's kind of what I'm looking at with the euro. We'll take a look at the cable really quick. Like the Aussie dollar, the cable pushed through these lows, and you can see now it's squeezing. Right, the Aussie did the exact same thing overnight. We hit new lows, squeezing everybody out. But all in all, we're still making lower highs, lower lows, right? So move this over here. So as you can see, the cable might be bouncing right now, but this area around here, we're probably going to struggle with, and might turn lower. Especially, looking at futures are a little weaker right now. Aussie dollar, very similar situation, right? Little break below the lows, squeeze higher, but I still think that the Aussie is going to trade heavier today while we're below the 68.50. The Kiwi dollar, another similar situation, a break below lows, squeezing everybody right now. So everybody all the Europeans that were shorting or playing the dollar on the long side, you can just put it that way, they're playing the dollar on the long side earlier this morning. They're just kind of getting squeezed out, as we head in North American trade. Dollar Canadian, similar false breakout here. And so, just looking around, it seems to me that the dollar might give back a little bit of these, of these recent gains. But, if stocks stay heavy, then that is going to be an upside risk for the dollar. So let's look a little bit at the stock market. So the stock market, we have pulled back. Okay, here's the fib, right? We're below the 24% retracement right now. The 38% retracement comes in at 28.38, and I think that's ultimately where we're going in the S&P. So, and remember, we are actually outside of the ascending wedge. We broke down outside of the ascending wedge. We came and tagged the underside of the trend line and then rolled back over again. So I think eventually the S&P is heading here to 28.30. So if that's going to be the case, what should happen with the US dollar? Well, in all actuality, the US dollar should continue to gain strength if the S&P and equities just in general continue to stay weak.
That's a great look, Blake.
Oh, thanks, Dale. But
yeah,
I think that as long as we're below this 3,100, and you can see it right here. This is I think I drew this on the week ahead video, if I'm not mistaken. That's where I drew that line. As long as we stay below 3,100, I think the risk remains lower. It doesn't mean that we can't just bop around here for a while. And it surely doesn't mean that we're going straight to, 2,800 like today. Today we could bounce right back above 3,000 and, and just kind of bounce around as we're making our way lower eventually, I think. Right. So one of the things that's a little scary, and Dale, I know Southern California is, very similar situation, not as bad as Arizona, but the uptick in COVID cases is really quite concerning.
Yeah, you guys are reaching capacity in the hospitals.
Yeah, we are. We are here in Arizona. Yeah, so things are a little scarier, and I think that the one thing that I do want to mention is I don't believe that under any circumstance moving forward that that states are going to close down again. I really don't believe that they're going to. I don't believe any states are going to go back into lockdown. I may be wrong, but I don't foresee that happening.
I agree with you.
Yeah, I don't think people are willing to take the economic risk despite the.
Yeah, I think the same is going to happen to the rest of the countries. I've been saying here in Greece as well that even if we have a comeback, I think they've learned the lesson. I mean, the economic devastation is so huge that even counted in human lives, I believe that the economic consequences will produce more dead people than coronavirus. There are other solutions like, you know, isolating people that belong in
Yeah,
sensitive
the old men.
groups.
Yeah,
Yes,
the old
groups,
people.
yeah, of the population, and
Yeah,
letting the rest be productive.
have fun and keep
Have
the
fun,
old
no.
people at home.
Yeah, have fun, no. But yeah,
Work anyway.
yeah,
Anyway, I
Yeah, I
saw your
mean,
prime minister yesterday was on Sunday morning,
yeah, Santorini.
and
Yes,
he was on Santorini. Boy, looked beautiful there.
it is. It is beautiful.
Those white buildings, those ancient looking, that construction. Wow, is that what I
Santorini
was
is
seeing?
probably one of the most beautiful places on earth, I think.
Yeah,
It
yeah.
is definitely very different because it has the volcano, and this creates like in combination with the Aegean Sea, this creates a very unique scenery.
Okay,
You know what I have to say about Santorini before we continue on here?
but
uh, the wine is horrible
uh,
there. So the wineries are not, the wineries are not good. If anybody ever says, "Oh, you should try Santorini wine," yeah, forget about it. If you know much about wine.
you'd go with Uzo there, huh, Blake?
Oh no, the ouzo is great. The ouzo is great, but
All right.
the wine, their wine country is not so great. Anyway, and I actually went to a few wineries while I was in Santorini the last time. Anyway, so hey Steve, how's it going today?
Good, mate. How have you been?
Good, good. So I was also paying attention to the U.S. dollar Mexican peso, which I think this is a currency pair that if you really want to have a beat on if stocks are going to continue lower or if they're going to bounce back, just keep an eye on the US dollar Mexican peso. And what you'll notice here is I think the dollar mex, and let me delete this. It's really kind of trapped, right? So if we start spiking higher towards resistance, that is an indication of risk off, which means that the stock market's probably going to start coming under pressure, which just so you guys can see here, I mean, whoops, that's not the 2 hour. Here's the 4 hour. I mean, we're not far off of our highs. So I mean, if the dollar Mexican peso starts spiking back up towards highs, that is an indication of risk off. The flip side is if we come back down and break through the 50% retracement here, that remember the 2205 was a big deal. That was a major support resistance. It was the breakout point here. And that all comes in right around 2205, 2205, 2210. And if that starts to give way and we start to break back below that is an indication to me that stocks are going to rally. But again, while we're holding gains, you can see right now even the S&P is still trading a little heavy here. So but keep an eye on the dollar Mexican peso. I think that's definitely should be on your radar at all times, especially if you're unsure about what equities are going to do at these levels. So, Steve, I want to ask you this because this happens from time to time, and this morning it could be a little bit of a topic for conversation. You had a wonderful pattern in play. If you guys are not familiar with the patterns in play, that's a setup that's technical that one of our teammates have identified, and we'll put in the stops and the stops and limits based on what we see technically that would be more by the book, and what you see here. Sometimes you'll get a target hit or you'll get an invalidated, which means a pattern was the stop was hit or the target hit was it hit the target in particular. But you closed out your pattern in play a
Yeah, I
little
did
early.
it yesterday night, actually. Yesterday night, my time. I mean, after the markets were opened.
Okay, so I guess the question is why did you close out the S&P short? What provoked you to do that, and what do you see moving forward?
I still think that the path of least resistance remains lower no matter how you look at it. It was just, it was Sunday night. I don't trust so much the price action here, at least, shorter moves. We had an initial move lower, which got retraced, and then another attempt, which had the same. So, since we came very, very close to my target, I didn't want to have to monitor it overnight. It was a pattern play that produced within like a few hours of trading action, almost a full profit. So I thought it was, a good idea to close it and reopen it if we get a decent rebound at resistance again. I mean, open a new one, obviously.
That makes a lot of sense. Okay, so you're looking for a resumption of downtrend in the S&P then?
Yeah, absolutely. I mean, you always have to be a little bit skeptical because we know how artificially supported this market is. But even under that scope, I think that we should at least see a few more days. I mean, best case scenario, just a few more days of downside. I wouldn't be surprised if there is more to it. I mean, if the market succumbs to actual market forces, we can see much lower levels than we currently are. But that's a big if.
Yeah, I think it's possible too. There's other currencies like I pulled up the Aussie yen, which I think is a pretty good barometer for
Indeed.
risk aversion and risk appetite. You can see clearly the head and shoulder pattern here that's trying to play out. I mean, yes, it got a little bit of a bounce here over the last hour and a half, but overall, the pair still is trading pretty heavy. Which if you look at equities, I mean, even though we've bounced back, I mean, the S&P is still down almost 2%. Russell's down 2.6%, and the Dow futures is down like 2.3%. So the markets are still trading heavy despite them bouncing off of their worst levels in European trade. So, and the dollar yen is kind of confirming that. Anyway, it's nice to have you here this morning. I don't know if Stelios is in.
I think he is.
I'm self-isolating because I'm one of the old people, aren't I?
Because you're one of the what?
Old people now.
Well, hey Stelios, good morning. Steve, hey. I hope you had a wonderful birthday over this weekend. Happy birthday once again.
Market reversal definitely made it better.
Yeah, right. Good. Well, I'm going to pass it over to you guys, and I just want to say, if you are part of the Forex Analytics family, thanks for supporting us. For those of you that are looking to be part of it, one of the ways that you can take advantage of the Forex Analytics platform is be part of the reimbursement program. So if you go to the reimbursement program on our site and you connect with one of these brokers, if you don't live in the US or Canada, your trading could quite possibly get you involved in the Forex Analytics family. So this connects to Forest Park FX. So just you can contact them, you can email them or Skype with them directly, and see if you can be part of the reimbursement program, so you can be involved with our Forex Analytics family. So guys, I'm going to pass it over to you. Thanks everybody for tuning in, and it's all yours, Steve, Stelios, Coach.
Thank you, Blake.
All right, thanks guys.
Thank you. We have some US data in about a minute, but before that, first of all, hi everybody.
Hi, Stel.
I think we're seeing a continuation from Thursday's move. Remember, Thursday's when the markets really bombed out, and then Friday we had a little bit of a correction, but now we're seeing more downside. I'm waiting to see what's going to happen on US Open. That's usually pretty indicative. It's in 1 hour from now. But really, the markets are not looking good.
We have data coming in out in 15 seconds.
15 seconds, yeah.
US New York Fed manufacturing expectations are for minus 29.8. The previous was minus 48.5. And Canadian manufacturing sales expected at minus 20, with the previous having been at minus 9.2. We
Oh,
just
Empire State, very good. It's flat basically.
yeah, New York Fed Manufacturing minus 0.2, which is a huge improvement over what was
Yep.
expected. Oppositely, Canadian manufacturing sales worse than expected, minus 28.5. As I said before, the expectations were for minus 20. So let's see. Theoretically speaking, the combination of better than expected US data with worse than expected Canadian data might keep on fueling this USD CAD rebound to the upside, but we're going to visit that later when we start talking about the charts.
Yes.
Go ahead, Stelio.
Well, the question again remains equities, and to be honest, anything you trade, pretty much anything, you can say it's a risk on or a risk off instrument.
Yeah, it's a one trade
as simple
thing.
as that.
Yeah,
and,
it has everything has turned to a
yes.
one trade.
Yes, and we were saying for a couple of weeks now, quite vocally, that look, this rally is becoming a little bit extreme. There's way too much positive priced in. I would love things to be the way markets expected, but I said I was doubting that was going to happen. And personally, I was reducing my risk on positions. So I reduced my silver longs, I reduced my Norway longs. I started shorting the S&P, very small sizes, but I shorted some at 30.50, some at 31.15. I wrote all that on the chat room when I was doing it, and I'm still riding that. And I do think that we have a leg lower. First level in the S&P is I think 2,700 or something like that. Then it's going to be a lot about price action, how it gets there, etc. But I wouldn't be surprised if we go lower than that. If you think about it, you have so many economies that are opening up now, and that's why we're seeing better numbers than expected and improvement. And we might continue to see better numbers for May at least. But things are starting to look a little bit worrying again. In the US, there's some cities, some states which are reporting quite large numbers. I was reading today the Indian city of Chennai, or however you pronounce that, is in lockdown again. So, it's I don't think it's going to be plain sailing, unfortunately. And I think that there will be a second round effect at some point. Will it be now? Will it be in the autumn or winter? I don't know. But I was saying from the beginning, there's way too much positive priced in, and I think we're starting to see this move.
Yes, and even if the economies don't get locked down again, when you have the stock markets pricing in, like coronavirus just magically disappearing and the economy magically rebounding to what it prior was, even any side effects of the coronavirus outside of locking down the economy, because as Blake said, and I agree 100%, I think it's probably unlikely that they're going to be locking down economies again, because I think they've realized that the damage is probably bigger than the benefit, even in human lives. I mean, I'm not talking numbers. I mean economic numbers. I think, Stelio, that even any disruptions that might cause was definitely not priced in by the markets, right? Yep. So a comeback will create inevitably some disruptions. I mean, at the very least, let's assume you have a second wave and they don't lock down anything. Okay, will people be going out in open restaurants just because they're open? No. Will they be going out in malls and doing,
spending?
No. Spending? No, they won't. So, I mean, everybody's also going to be quite worried because, even if they don't intend to lock down the economy, people will be worried that the economy might go in lockdown again, which means that, for example, employment is going to be a totally different story. Companies are going to be much more hesitant to employ people or bring back people that they've actually fired. People will be spending a lot less because, if they want to be prudent, they're going to be thinking that, okay, who knows, I might lose my job. So, I'd better, save a little bit for a rainy day that looks like it's likely to happen than find myself, without having anything on the side. So, considering all that, it's really dumb for anybody to believe that you can flip back a switch and everything magically returning back to normal.
Yeah, I agree. The thing though is we have to keep focus on what the long-term play is. And in my opinion, the long-term play is a lot higher in all indices, in real assets. We've talked about this many times. So there will come a time for me to be very, very bullish equities. Not because I think the global economy is going to be on fire, but I just think the way they're going to try to
inflation.
Exactly, inflate. Well, the US have been inflating their debt away for decades, and pretty much every other country, and they're just going to do the same thing. I think the continued easing that we are seeing and will continue to see will just drive the purchasing power of currencies lower, and so the prices, the nominal price, is higher. End of story. So that's what that's why I think in the future. That's why I'm bearish now, but I am waiting. Really waiting for lower levels to get quite bullish.
Yeah, and we know that the first place that inflation has been going due to what we call in economics, excuse my pronunciation if it's wrong. Are you familiar still with the Cantillon effect?
The what?
Let me write it for you.
Cantillon, yeah, okay.
Yeah.
Is that French? Or Cantillon or Cantillon, whatever.
In essence, it tells you, I mean, making it very basic, it tells you that, the effect of inflation, of fresh money, is, of course, bigger and higher at the area of initial injection, which makes sense if you think about it. You know what I mean?
Yes.
Yeah,
okay.
So, this is the effect actually that makes inflation be so much more apparent in financial assets, because that's where it gets initially injected. You know what I mean?
Yes, absolutely. So yeah, that's my long-term view and my short-term view. So I'm still waiting now for a little bit lower levels. And as I said before, depending on the timing and the path that prices take, then I'm gonna maybe exit earlier or later, and then go long. But one step at a time with all that.
Anything else that we had during the weekend?
Some minor, actually not minor. We had some data out of China worse than expected. Industrial production, unemployment. Actually, no, that was fine. Retail sales worse than expected. So really, it's not the China is one of the drivers of the world, right? And it's really not recovering as well as markets expected. So this is another thing to keep in mind when looking at equities, because let's face it, equities are driving everything. So, but apart from that, it's been pretty quiet, waiting to see what's going to happen with the Europeans and the Brits on the continuation of their talks. It's the never-ending saga, but in the end,
I don't want to be misunderstood, and I'm obviously not happy about it. But ancient Greeks were saying that there is always something positive coming out, even from the worst situation. One of those positives from COVID, if you ask me, was that we got to forget a little bit, put it in the back burner, this annoying saga with, the Brexit. I mean, it was, it had gotten so old and so tiresome. At least, it was less important. So we got a little bit of a breather from that. But as you said, I'm afraid that inevitably it's going to come back to the forefront at some point, and we're going to have to deal with it every single day.
The English have said, the British have said that they're not going to extend again. They're not going to seek another extension. So it's year end, and that's it. So they have 6 months to come up with something. They've had 3 years. They haven't done anything. So yes, they're going to do it in 6 months. Yeah, let's see. Otherwise, it's been very quiet. It's been quiet today, this morning. Equities obviously not doing well, but really nothing yet moving the needle elsewhere.
Yes, so starting the charts from equities, obviously, I like the price action. First of all, I like the price action that we had on Friday, because after getting a confirmed breakdown from this, you want to call it a wedge, you want to call it a channel, it doesn't really matter, as I explained on Friday, because the trend line support is exactly the same. So what I liked on Friday, and I took advantage of that and made my pattern play, actually, was that the market retraced part of that huge bearish candlestick, retested this broken trend line support as resistance, and just lost the ground under its feet once again, and we got that move. We found a low exactly at the 23.6% fib of this rebound higher, and then we closed a little bit higher on the day, but still definitely not a positive day having to do with price action, considering that the market came out from that huge move lower on Thursday. So the fact that stocks were barely able to retrace a little of that, was a testament that the market is clearly now under pressure.
Closing under that 200 days, Steve, is going to bring a lot of attention to the sell-off.
Dale, I think that already some of the people that fell for the FOMO are starting to get really worried about it, and you know how that works. I mean, we even see all these ridiculous stories about Robinhood and people that are doubling down on stocks that of companies that have actually gone bankrupt. And you know something, some of them will be patient initially, but you know that the retail crowd has a very, very short temper, and their psychology is is very easily affected by by market moves. I mean, we know that the psychology of price affects even professionals that are doing that for a long period of time. Imagine people that just started trading because they thought it's a good idea and they can make easy money. So
this is the process they go through.
Yeah, so
a day trade that's wrong turns into a swing trade that turns into a position trade, and eventually becomes an investment.
Yeah, exactly. So history tells me that even if the market is to return to an uptrend, which is likely, I mean, it's not logical, but it's likely, because we know that the whole situation and the conditions we have are mostly characterized by being illogical, right? But having said that, what remains the fact is that I think that the market is first gonna send all those people back home initially. You know what I mean? So I think that the market can resume higher, but it is extremely likely that it's going to do so without those.
Let's hope back home instead of back homeless.
Yeah. So, even if we are to move higher, I think that the market is going to first kick out all those people that thought that they can make very, very easily money just by buying everything that is beaten down, everything that is actually quote unquote undervalued, because they, always amateurs judge what is undervalued or overvalued purely based on how much lower it is from its recent highs and nothing else. That's their only criterion. So, if they see a big move lower, they immediately want to buy it. If they see a big move higher, they immediately want to sell it. Now, especially, when most of them are reading that, the Fed has your back and, et cetera, et cetera. What they're doing is what we've seen. They're trying to pile on cheap stocks. For some reason, I've seen amateurs think that when something is cheap, so for example, when a stock is like $3, they think it's a great opportunity because you can buy more stocks at the same price, which makes no sense because, irrespective of how many stocks your capital can buy you, still if the stock moves 5% lower, you lose 5% of the capital you invested. If the stock moves 5% higher, you make 5% on the capital you've invested, irrespective of if you manage to buy 10, 1,000 or 5,000 stocks at the same price. But anyhow, for those people, it seems to have a psychological effect as well. I mean, thinking that, I bought 1,000 stocks, or like I bought 10,000 stocks, instead of saying, I bought 50 stocks of a much higher valued stock. Anyhow, so going now to the 4-hour chart to look for some downside targets. First of all, earlier today, we did test and we rebounded from there. This confluence of supports, the 61.8 from that last leg higher in the S&P, and this horizontal support resistance area roughly at 29.40. So we rebounded from there. Now, obviously, as long as we are trading below this bear flag, we can easily just see the fulfillment of this flag. That would imply a target of 28.53, almost 28.54 actually. Now, other downside targets I'm watching are this one, 28.70. You can see horizontal support resistance area. And then we have this 27.90 area, and below that we have 27.20, and below that we have 26.20, 26.30, which was my initial target since I started shorting this rebound on the way up. Speaking of which, I'm in the money now in both Nasdaq and S&P positions, so that's been working nicely. But I'm not going to let it run against me. I'm actually going to be trailing my stop loss. For example, in the S&P, I'm going to be trailing my stop loss at 3.1k, meaning above this recent rebound that we had on Friday. And we'll take it from there. Now, as expected since the very beginning, this downtrend in stocks has obviously created a reversal in many currency pairs, especially those that, not only though, especially those that have US dollar as one component, or those that are very well correlated with risk. For example, we said since the beginning, Euro Aussie, Euro Kiwi. There we go. Speaking of which, I have to warn a little bit here. Euro Aussie and Euro Kiwi have been rebounding, and from a PIP perspective, quite a decent rebound. But keep in mind that these pairs can move substantially higher within a very short period of time. But we haven't yet broken the equivalent downtrend. So nice rebound so far, but not like a very clear indication that the trend has changed so far. Euro Kiwi, for example, it's not beautiful, but you can even see here an inverted head and shoulders formation. As I said, not beautiful one. I mean, not one of the best looking ones having to do, with symmetry, etc. But that doesn't mean that it isn't one. So here it is. So that's one formation you can watch. Clearly, a break above that would indicate quite a lot more of an upside. And obviously that's going to be happening if we see stocks remain under pressure for a period of time. Now, one of the pairs that remain very, very decently bid, and Blake mentioned it, is the Euro USD. Now, I do think we can see more downside. I would start paying close attention, though, once we get close to this 111.50 area. I will start paying close attention, because I wouldn't find it unlikely to find support either there or at 111 or at 110. 110, quite an important area. So I do think that this pullback in the Euro USD should probably be bought. Now, I don't necessarily think that it's a good idea to do it already, but I think that we might get a decent opportunity within the next few days, perhaps even within the week, if not like next week or whatever. But the way the Euro USD is responding so far, I think is clearly showing that something has changed. So I don't think selling is the good idea. I think that the better idea is buying when the risk reward is appealing. And as I said, we're not far away from getting a decent risk reward to do that. Now, clearly, the move we've seen lower in stocks has completely reversed the situation with bonds. A lot of people started thinking that that failure we had, for example, in US Treasuries was like the beginning of something big. Personally, I was extremely skeptical. I was still expecting that one way or another we're going to see at least one more high, because as I was repeating, I was expecting at least, even if it's corrective, at least one more move lower in equities. We're now back at this, key horizontal resistance area. I think it is very, very likely that within the next few days, we're going to be breaking through that area and pushing higher, meaning that yields are probably going to be producing new lows, new all-time lows. Keep in mind that the previous low was at 36 basis points. I wouldn't even find surprising to see yields, near zero. So here's the 10-year. It looks like a triangle, which is a continuation formation. Here's the 30-year. As you see, same deal. So in both cases, I think the path of least resistance for yields remains lower. Right? There you go. Now, unsurprisingly, because this is not the first time we see that, now that we have some liquidations happening, we're seeing gold and silver not really performing well. Part of it because, the dollar is getting a bid. So there we go. Quite a decent move lower so far today in gold, a bigger move lower in silver. Now, keep a note here because silver is actually breaking through this ascending channel that was defining the uptrend, which means that we might see a deeper correction, which isn't really a big surprise. I mean, I said that at some point I would expect a leg lower, and depends on how we close today, that might be the signal that it has begun. Decent area of support in my mind is it's going to be a good opportunity if we see again the metal trading like anywhere between 1550, 1570. I think that's going to be a decent buying opportunity. I'm probably going to be buying it down there. Now, having to do with gold, as you see, it's far away from actually producing some type of a bearish break. So far, still remains in some type of a consolidation here. And, as I've said many, many times, I think it's a bad idea trying to trade short monetary metals. I think it's a bad idea under the current economic environment. I think it's probably a much better proposition to try to buy weakness than trying to sell strength. But that's my personal point of view. Everybody does what they believe is best for them. Now, admittedly, crude is holding up much better than I expected, given the move lower in stocks. We did have Thursday being quite a weak day, along with that big sell-off in the markets, but the crude market is still holding this steep ascending channel. And so far today we're seeing a consolidation. I mean, we see an inside day to the pin bar we got on Friday. Now, clearly, having seen this massive rally to the upside, I think that the risks are tilted to the downside. So I do think that unless we see such a quick rebound in stock markets, which I think is not the likely scenario, I think that weakness should prevail for at least a few more days. I think that probably that means that the crude market presents here quite a decent opportunity, because if stocks don't immediately rebound higher, crude will have some catching up to do. And I think it will do some catching up. I'm expecting at the very least a pullback towards the $29 area. And keep in mind, that's like $4 lower. And $4 from where we currently are is more than a 12% move to the downside. So, quite a decent short-term selling opportunity here, if you ask me. Now, another pair that is pulling back, unsurprisingly, given risk appetite, is copper. So copper did find resistance at this confluence of resistances, ascending channel trend line resistance in the 78.6 from that move lower. So far, the pullback is orderly, but keep in mind that if we do break below 248, I think that this move can actually accelerate to the downside. So, you want to be long copper, you want to be buying it. Okay, I mean, that makes sense from a technical perspective as long as we trade above 248. But, we bridge through 248 again. I think you don't want to be on the side of the market, if you ask me. Blake already mentioned, and we've shown this so many times, Aussie, Kiwi, Aussie Yen, Kiwi Yen pulling back with risk. Keep in mind, I have, this channel drawn a little bit differently. On my chart, the Aussie USD is still barely holding this ascending channels trend line support. Kiwi is quite a lot higher, having to do with its equivalent channel. You can see it here. Anyhow, finding support in this support area. The Aussie Yen, exactly as the Aussie USD, is on its channel's trend line support. So, from a risk reward perspective, in the short term, I would understand why somebody would want to be buying them. Personally, I wouldn't. But from a risk reward perspective, you can take like a very small risk, and if you get lucky and stocks go back bid immediately, you can find yourself with quite a nice trade in your hands. But as I said, personally, I think we're going to see at least one more leg lower. So that's not the kind of thing I would be doing here. Let me go through some of the questions. What are your thoughts about NSD? What is NSD? And the DAX. Now, yeah, DAX. I can tell you about the DAX. Oops. Wrong area to open the chart. Okay, so here's the chart. So the NASDAQ, clearly pulling back, at the same time, still holding this channel's trend line support. We haven't actually even tested it yet. So, it's quite clear here. I mean, the closer we get to this trend line support, the worse the risk reward becomes to remain short. Now, breaking through 11,400, I think opens up the door for quite a lot more of downside. I think in that case, we'll find ourselves quite close to 10,000 probably in very little time. TLT, listen, I showed you the 10-year, I showed you the 30-year. Trust me, TLT is, no different than that, right? I mean, it's more or less, all of the bonds look the same. All of the US bonds look the same. They look like they're still in a consolidation that is likely to break to the upside if we're talking about bonds, or if you're looking at the yields, we are consolidating in triangles, which look likely that they're going to be breaking to the downside. So they look likely that they're going to be pushing to lower yields before we can see like a stronger recovery higher. Ziggy says, I own 1 million shares of XYZ at 1 cent per share because it can't go down. Yeah, my thoughts on Aussie Yen. Yeah, I just mentioned that. Yeah, like a couple of minutes ago. Aussie Yen currently on trend line support, but I think that it's not going to hold. So from a risk reward perspective and from a technical perspective, it looks like an appealing place for somebody to be buying. You can clearly see why. Extra reasons, if you want extra reasons that would make sense for somebody to be buying here. We also have this horizontal support area, and you can't clearly see it, but if I zoom in, you will be able to see it. We also have the 200 daily moving average here. So this 72.25 to 72.50 area, quite a formidable cluster of supports gathered up in this area. But having said that, my intuition tells me that we're probably going to slice through this area and produce at least one more leg to the downside before we can actually see a recovery. What about the FTSE?
You have female
100?
intuition, Steve?
No, I never said female intuition.
All right. I thought only they had intuition.
Who knows? Yeah. So
Stumped.
here's the FTSE. I think the FTSE has broken through this, in my opinion, and I said it since the very
Yes.
beginning, corrective formation. So I think the risks are clearly tilted to the downside. I think that, between buying or selling the FTSE here, in my opinion, it's no brainer. I would be selling it. I'm actually short other indices, so I'm not going to be doing anything with the FTSE. But if I had to trade it, I would not even think about it. I would be selling it instead of buying it. Next downside area of support 5,750, and below that 5.5 thousand. Dale, I just see that we're exactly at the top of the hour. You said before that we do have a guest. Is your guest here? Because I don't want to.
Yes. Yes.
Okay.
Keith Dicker from IceCap Global is
Okay.
with us today, and
Perfect.
be talking about some piece he recently wrote. I think you're going to want to hear this, knowing what a dollar bear you are. Just for another.
Oh yeah, I'm a
point of view.
long-term. I'm a long-term bear,
Yeah,
unquestionably.
You're looking for wheelbarrows full of dollars and people stealing the wheelbarrow.
Yes, but as
Okay.
I've said many times, not yet.
Okay. Well, this may be what the pause is about. So great as usual, Steve, your breakdown of the markets. If attendees didn't know what was going on, they do now. So I'm going to get you set up now, Keith. Looking forward to speaking with you again. Your last interview was top shelf. Okay, Keith. I asked to unmute you. So it's up to you to unmute.
Yeah, I see
microphone.
him. Yeah,
okay.
He's unmute. There he goes.
There you go, buddy.
Yeah. So I'm
right.
a brilliant money manager, but not with I'm not brilliant with Zoom sometimes.
Yeah, well, kindred spirit. So these guys dragged me kicking and screaming into the 21st century, and you should see me try and draw a trend line or anything on TradingView. People laugh, my hand shake. Anyway, Keith, last interview was very informative. I'm really looking forward to this one. If you can share your screen.
It's a green button that says share
yeah.
screen.
Yeah, sure. I don't have, I have a few charts we can jump around with, but I didn't have a specific presentation. We can go walk through a narrative, and then I can share a few charts with how we think things will
move or you know what? I could show the narrative's going to be dollar related, right?
Okay, sure.
Isn't it? Because I want to talk to you about your view on a recent piece that's been floating around Twitter, and I read it, and it has to do with the revaluing up of the US dollar. And I find it interesting that you went from a 0 probability of this happening to, I believe, if I read it correctly, that there's a decent probability that it could happen. So first of all, why don't you just give us a little bit of the cliff notes of what you're trying to communicate to the trading public about the dollar here.
Sure, we'll take a run through it. So this piece, probability of revaluing the U.S. dollar, that was written by my colleague Keith Oland. So he's a really strong global strategist, and so he's the one that wrote that piece and came up with the narrative for it. So, but we all live and drink and eat the same food together. But so let's just run through the narrative. And the reason we wrote that piece, so we're a global macro managers. We run long-only portfolios, as well as we run a private fund as well. And all the themes and the strategies that we use, we have them structured, Dale, so that in our mind, we want to avoid markets where we believe the risk-return opportunity, it's just not in your favor. Think of the Hunger Games theme, they had that. But we want to avoid markets that we figured would have the opportunity of significant losses just overwhelmed your upside. So the bond market, for example, right now today you're looking at maybe a 2 to 3% upside, and your downside is a lot more than that.
Are you? Let me just interject. Are you a little surprised since our last interview how well the bond markets have behaved since that wild blow off at the end of March and then a cratering, and your thoughts again on the Fed coming into junk bond and corporate bond markets? Does it change the game? Have they nationalized the bond markets here, Keith?
Yeah, in some ways they have, Dale. So with bond markets, of course, you have to separate them between treasuries and everything else, or bonds, for example, as well. What they've done effectively, they removed the entire price discovery process. And, it's not for us to agree or disagree with it. It is what it is. And for anyone managing money, whether it's your own or if you're a fiduciary, it never pays to, dig your heels in and say it has to be this way. And instead, you have to look at it and say, hey, this is what the central banks are doing. Now let's manage around that. So what they've done, they've effectively tried to take risk out of debt markets, specifically out of credit markets. And, they've as well, they're providing support as well to the high yield market. So, pricing, the main ETFs people look at, of course, they've come right up. And they've also caused spreads to narrow as well. What we look at then, we have a vision how we expect all this to play out, Dale, and it plays in with the dollar as well, of course. So the first phase of the crisis or stress return in the markets, in our mind, was always going to be in credit markets. So not sovereign debt, it was going to be in high yield debt, investment grade credit. And once the crisis hit back in February, March, that's exactly what happened. And the main feature of those movements, what everyone should take away really, is that there's no liquidity in those markets. As soon as there's a sniff of risk or danger, everyone fled. I mean, we all know the stories now. Big books were trying to sell. There was no bid on corporate debt, nothing on high yield. Again, it's a completely different market than equity markets. Well, you'll usually always find a bid and offer in there.
Larger too.
Yeah, absolutely. And, it's like the gymnasium, it's a big dance, but there's only one exit at the end of the gym. That's exactly what the bond market is. So with the Fed doing what they did, if I was on the central bank committee, it would be our job to make sure credit is flowing through the system. And that's what they did. So it's understanding what they're going to do. So what happens next, though, it's real interesting. And we always say, like, if one event happens, then the probability of the next event happening increases significantly. Then if that event happens, then the probability of the next event increases significantly. So with our path, or vision that we see happening, we wrote about that in our last global outlook as well, called the Law of Holes. And so the first event would have been credit markets. That has happened. What we expect to happen next would be to see risk start to emerge in the emerging market world, so both equity as well as credit and sovereign debt and currencies. And that is a market that the Fed has not locked down. They can't lock it down. The ECB can't touch it directly, nor can the Bank of Japan, and so forth. And that's where risk will move next. So in our strategies, we're no longer taking active exposures to credit markets in the developed world. And instead, we moved along to the emerging market world. But because risk first happened in credit.
What country in the emerging world do you like? And give me a symbol.
Well, it's more important to say which one do we dislike, Dale.
Okay, all right.
So
okay.
we're on the short side.
I see. Okay,
yeah.
You're on the
short. So
okay.
Yeah, so we expect contagion to occur, but I mean, if you look like specifically Turkey, they have a lot of challenges. So if you're an investor, and if, this is also with China as well, when you make an investment, you say, hey, is this a good value, good price? Do I get paid for doing it? But you need liquidity to get out. And that's, this ties with the whole dollar conversation. I think a lot of people miss in that. Say you want to park $500 million for one day. The treasury market is the only market that you can park that without affecting the price of the market on your way in and the way out. And it's deep enough to take that amount of capital going in. That it can't happen in China, and that when you look at Turkey, like back to the conversation about emerging markets.
Oh, and the bonds couldn't do that either, huh? The 10-year bond in Germany.
Yeah,
couldn't handle that amount.
It can take some liquidity, absolutely,
but not as much.
Not enormous. So, for example, when you look at emerging markets, they all rely significantly on the dollar for capital flow as well as for trade. And when you look at Turkey, so we look at Turkey, do we want to short various parts of that market? Absolutely. Do we want to short their banks, for example? We would. However, by doing that, we would have to go inside the country. And then we're concerned if we are right, then all of a sudden that market gets locked down. Just capital controls put on. So it's an example where.
Because they've had a currency crisis for years. The lira has been getting decimated, right? Yeah,
absolutely. But all emerging market currencies have as well.
Yeah.
I mean, I know with the dollar, people look at the DXY, the DXY all the time, and they're saying, hey, it's broken down a little bit recently. But the US dollar, if you look at the Fed trade weighted index, the dollar is now at new highs.
There's the lira right there. If you want to look at it, Keith, there's Turkish lira.
Yeah, absolutely. It's moving in line with all of them, like Brazil Real as well. Of course, it's there, South Africa. But the underlying theme, all these guys, they're starving for dollars. And I know there are a lot of dollar bears out there. And, it may surprise you, but we are bearish on the dollar as well, but it's longer term. And you become bearish in the dollar when you realize, again, what the path is, through the crisis mode we go through. And the very last market to experience stress or crisis, it will be the dollar. And, that's something that's not appreciated in this system today. The other thing, we talk with people all the time, and it's interesting. I was chatting with a guy on Friday afternoon. He's managed some big money around the world, and we were talking about how this all works out and shakes out. And but the one point that really strikes me with a lot of conversations, first of all, like this conversation we're having today, I think it's being had by less than 2 or 3% of the market. That's it. No one else is having it. What strikes us the most, though, and it's very powerful, Dale, is that most people are not prepared to see a structural change to the monetary system. And that's what we think we're approaching right now. But because it hasn't happened, basically another Bretton Woods type event, that's what we're looking at. Okay. But because that hasn't happened in our lifetime, it hasn't happened for generations, people, they're just not prepared for it, how it looks, how it would feel. But that's where we're going. And the main reason we feel that way, I mean, if you go back to Bretton Woods, people talk about, the gold standard at the time, IMF, World Bank, and all that. But one of the key decisions from those meetings was the adoption of Keynesian economics. So everyone said, hey, this is what we're going to do. We believe we can control the business cycle or smooth it out, make it less volatile. And we'll do that by spending money, stimulating the economy, as well as by changing interest rates in the money supply. And, that works well when overnight rates are at, 4, 6, 8%. You have a lot of room to play with. Right. When we look around the world today, we're at 0. All of a sudden, they're introducing us to lower bound concepts and all that. But Keynesian economics and the ability to stimulate the economy, it's become increasingly ineffective. And for that reason, it means there's less dollars flowing around the world at the very point in time when everyone needs dollars to service debt, to keep the economies running, and so forth. So, it's pretty precarious where we are right now.
Yeah, Keith, I've talked to um, other analysts that, talk about the same thing, dollar denominated debt and, what could create a surge in the dollar. What I found was in the piece that your associate wrote, is that there's a political angle to it, that it's being done to weaponize the dollar. And we know whenever we're weaponizing anything, who the target is in the last several years. So can you explain to me and to our listeners that, it was always my belief that the Chinese wanted a weaker yuan, so a stronger dollar would actually be achieving their purpose, so they could export more, even though they're supposedly becoming more of a consumer society. How does a strong dollar squeeze China?
Yeah, it's so with this piece that Keith Olin wrote, my colleague. Again, just when we want to challenge people to think differently. So just to preface this, what you need to understand first is that everyone in the world who is following this closely, and that's at all the central banks and at different levels and governments that should be aware of this. We all know the world works incredibly better with a weak US dollar. It's just the way it is. It doesn't matter if sterling is weak or Canadian dollar or euro. If the US dollar is weak, it ensures that capital flows, trade flows, and so forth. Because we know that, and they all know that, and we look at the stresses around the world today that are really being caused by a lack of US dollars flowing, it's quite obvious that, hey, the decision should be, hey, let's weaken the dollar. That will fix a lot of things around here, but they can't do it. Yeah, they're trying. People would say, people who follow the gold market, they're holding gold for a number of reasons. It's a great store of value, and helps protect you during moments of crisis. But when if I said to a gold investor, without them seeing the market, how central bank balance sheets would have expanded and deficits going and all this stuff, you'd think gold would be $5,000-$10,000 right now, but it isn't. And if you accept where the market is right now with the dollar and say, wow, they cannot weaken the dollar, then you have to look at it and say, okay, well, what's going to happen? So the dollar is going to strengthen. And from our network, we know this is being discussed at some pretty high levels, and they've really come into accept the faith that, hey, we cannot weaken the dollar, it is going to rise. So then we come back to the whole China discussion and the piece that we wrote. So in one way, if it's going to happen, because of the way geopolitics works today, there could be a mindset to say, you know what, let's make it happen. And then you say, if it did happen, who would not benefit from that? Who would be at disadvantage? And that's when we look at China. So the concept that in a normal world, if you have a weaker currency, you can export more, you do better, right, and all that's absolutely true. And that's true in a normal business cycle. The problem with China is that because their currency is pegged, their capital account is also pegged. So, for all of our economists out there or accountants, think of a country having a current account. That's where their trade will flow through. And think of their capital account. That's where you get capital and investment. So usually you'll have a surplus in one and the deficit in the other one. So for example, the US, they have a current account deficit. That's because of net trade, and they're spending more than what they're producing. But yet the Americans have the largest capital account in the world. Foreign money will come in from China, Russia, London, Brazil, Australia. It will go into the US to invest because they like the rule of law. They like the investment opportunities that are available. They know there's liquidity. They can get the money out if they need to. Policies are pretty consistent and so forth. China does not have that. So if China were to want a weaker currency, they could remove their peg and the currency would drop immediately. Then it's okay, why wouldn't they do that? These are smart guys. Everyone is smart out here in the world. The reason they wouldn't do it is all of a sudden their capital account is no longer closed. And you're going to get a lot of very nervous investors in China, and their money will be flying out the window. So all of a sudden you have money flying out of the country. It creates less jobs, less economic activity, more social unrest, and so forth. So it's a pretty tight game out there right now. So with the concept of that, with the US dollar, it could be revalued. Before it was a 0% chance. Right now we're telling people, hey, it's no longer a zero. So whether it's 1% or 10%, we don't know. But we do know it has been acknowledged at some pretty high levels in the US that, hey, a strong dollar will have these effects on China. And it'll have effects everywhere else, but that's just, that's collateral damage and financial war. So, it could happen, and it would.
How do they make it happen? You said that their decision, knowing that it probably will happen, could shift to let's make it happen. How can they make it happen? How can the U.S. government make that happen?
Yeah, well, the simplest way to do is to simply, you have
Raise
the president,
rates?
And no, they
Or
wouldn't have to do that at
jawbone?
all.
Just jawbone?
Yeah, the old moral suasion. If you remember back from our school days, that's what they would do. Even that in itself would work. But the bottom line, though, is that again, the dollar will absolutely experience crisis. It's structured to do that. However, before we get there, all of the other currencies will experience a bigger crisis first. So again, when you get crisis in credit markets, money flew into dollars and treasuries and so forth. If the next crisis occurs in emerging markets, which we feel it will, then it go back into the dollar. And then after emerging markets, then you'll have the major currencies like Euro, CAD, Aussie, Sterling. And then after that, you have yen, and then you have the dollar standing. So the biggest trade of our lifetime coming up actually will be to short the dollar, but you cannot be early on it. If you're early, you're gonna lose your shirt most likely.
Do you have any idea as far as what kind of levels during a crisis, based on Dixie or Euro or cable, how strong the dollar could get before the dollar peaks? Or that's a Nostradamus question?
No, I think you have to be reasonable here. I mean, if you're talking Euroland, Euro will break a buck. Absolutely. I mean, people tend to forget. I remember traveling to Europe in, I'm thinking 01 maybe. And Euro then was 88 cents, I believe, something like that.
Mm-hmm. Yeah.
I might have my year off a little bit, but I was living in a US dollar world at the time. And my travel friends, they were Canadian, so I think they were paying $3 for a cappuccino, and I was paying about 85 cents. So it's a big difference. But just back to price levels here. The parity is absolutely in play. With Euro, and you look at, for example, the Dixie. I mean, 125 is not out of the question. But the challenge we have is that because most people don't believe in this story, once it happens, it's too late. So you've already given the nod once to say, hey, it happened back in March, which means nothing has been resolved. All that we've done around the world is increase the debt levels. And the only reason debt levels have increased is because rates have remained at 0%. So that's where we are with it. When these crises begin, at the next level, they what they say, it happens fast. And so we could be, 3 months to 18, 20 months away, from this getting resolved. And,
I could actually make some type of technical. I wanted to see how we could get there technically, Keith. And, if you take this high in the dollar up here at 103 and the low down here of 88, that's 15. So you tack on 15 from 103, almost gets you there, 118 on a breakout to new highs. So
those are pretty good lines. Yeah, those are pretty good lines.
Yeah, you know what people say, people ask me, Dale, how do you draw your lines? My answer is with my imagination. So okay, so if this scenario is going to happen while it's happening, are global equity markets deflating to the same degree, worse in emerging markets than in, say, for example, the US? bigger percentage declines in things like this. China, I mean, China really hasn't gone anywhere in a long time. Here's your monthly chart going back to '09. I mean,
Mhm.
all these other bourses have taken out, well, the US has taken out the '08 high by a ton. And you look at the FXI, it's been sideways for 12 years and
Yeah,
not strong at all either in here with the recovery we've had in the US before what happened recently.
I just think people need to be. I mean, I know we've had a pretty spectacular rally in equities over the last few weeks, from the March low, but it's equities are fun to talk about. I tell everyone, hey, equities are one dimensional. If you really want to understand what's happening, go through the bond market. We're at, again, record lows in the bond world. The yield curve is being flattened. That sends a signal that, hey, money's either running for safety or it knows something other people don't. But we are clearly in this, what I would call a deflationary environment right now.
Okay.
And people need to pay attention to the bond market and the signals that it's sending along.
And are you shorting emerging market debt as well as equities?
Yes, we have positions on the debt side.
Okay. All right.
Yep.
So you're the opposite of Peter Bookvar. All right. So, and you're both very good thinkers. I think it's interesting. That's what makes the market. So, Keith, I'm showing your website, and this is where you could get a hold of Keith and talk to him. You could also reach him at his Twitter account, and it's at IceCap Global. And I want to thank you for, Monday mornings are tough for me at 4 in the morning. I want to thank you for getting up and hanging out with us and giving us, this scenario that, uh, in this Cold War that we're in with China, a revaluing of the dollar could be also a pretty good political tool to um, continue to pressure them. Will it be like you think it's going to be? I'm going to leave you with this because there are a lot of people. We've been in a Cold War with China for a long time, and you could be in a Cold War with countries for a long time, and then all it takes is one financial or economic. They start the war on that footing, and World War II, the oil embargo was enough to motivate the Japanese to start a war with us. Is this going to be enough for China to possibly think that we're being attacked, we have to protect ourselves, and this thing could turn into a hot war?
Uh, no, I think a financial war comes first.
Yeah, I know it comes first.
Yeah,
What comes
yeah,
second?
absolutely. I
Just
don't know.
Mad Max
I'm just
land,
worried
Mad
about.
Max.
I'm
Huh?
worried about the first step, and we'll
Okay,
make
all right,
money
all
off
right,
it, and that's above
all
my
right,
pay grade, maybe.
all right. Well, if we still have internet, we'll get back together and talk about it. Okay.
Sure thing. Thank you, Dale. I appreciate it.
All right, Keith. Thanks so much, everyone. That's Keith at IceCap Global, and a guy who has a finger on the pulse of some very major moves. Keith talks about the biggest trade of our lifetime being short the dollar, but from here to 120 is a pretty big trade in my view. So thanks again for your look and your view, Keith. Good hunting to you, and maybe we get back together in a few months and see how things are unfolding.
Yeah, absolutely. Thank you, everyone. Have a nice day.
All right, my trading warrior brother, Keith, and we'll see everyone for Turnaround Tuesday. Let me just look for this. Okay, hope everyone enjoyed the session. I'm going to wrap it here. Don't forget to count your blessings, not just your pips. See everyone tomorrow. Adios.